Today, we are looking at an important currency and economic argument involving the Vietnamese dong, and more importantly, what that argument can teach us about the Iraqi dinar and the broader question of currency valuation. The central claim is straightforward. The Vietnamese dong could remain relatively weak for an extended period because Vietnam competes directly with China for manufacturing contracts. At first glance, this may sound like a simple currency story, but underneath it is a much larger discussion about exports, wages, foreign investment, trade competitiveness, exchange rate policy, and how governments manage their currencies while trying to expand their economies. For Iraqi dinar followers, the Vietnamese example is worth watching because Iraq and Vietnam have very different economic structures, yet both demonstrate an important principle. A currency's exchange rate cannot be evaluated in isolation. The value of a currency is connected to the country's economic model, trade flows, productivity, monetary policy, reserves, inflation, capital movements, and confidence in the financial system. That means a strong economy does not automatically produce a dramatically stronger currency, just as a relatively weak exchange rate does not automatically mean an economy is failing. Let's begin with the argument surrounding Vietnam. Vietnam has become one of Asia's major manufacturing and export destinations. Over the past several decades, the country has attracted significant investment from multinational companies looking for competitive production costs, access to global supply chains, and an export oriented business environment. Vietnam competes with several countries for manufacturing investment, but China remains one of the most important competitors because of China's enormous industrial base, sophisticated supply chains, infrastructure, skilled workforce, and ability to produce goods at massive scale. This creates an interesting policy challenge for Vietnam. If the Vietnamese dong becomes significantly more expensive against major international currencies, Vietnamese exports could become more expensive for foreign buyers, all else being equal. That does not mean Vietnam wants a permanently weak currency, and it certainly does not mean policymakers can simply choose any exchange rate they want. Instead, it means exchange rate management can become one component of maintaining international competitiveness. For an exporter, currency competitiveness matters because companies ultimately have to compare production costs. Imagine two factories producing similar products for the same international customer. If one location suddenly becomes substantially more expensive because of currency appreciation, the buyer may reconsider where to place future production. Of course, currency is only one factor. Labor productivity, transportation costs, electricity, infrastructure, taxes, tariffs, political stability, supply chain reliability, and access to skilled workers can be equally or even more important. But exchange rates can influence the final calculation. This is why the statement that the dong could remain relatively weak for a long time should be understood as an economic argument, not a certainty. Vietnam has an interest in remaining competitive, but it also has an interest in controlling inflation, maintaining financial stability, and preserving the purchasing power of households. Those objectives can sometimes conflict with each other. And that brings us directly to the Iraqi dinar. Iraq's economic structure is fundamentally different from Vietnam's. Vietnam is heavily integrated into global manufacturing and merchandise exports, while Iraq's economy remains strongly dependent on oil revenues. That distinction is extremely important when people compare the Iraqi dinar with currencies such as the Vietnamese dong. Iraq does not need to copy Vietnam's currency strategy because the underlying economic circumstances are different. The Iraqi dinar is influenced heavily by oil export revenues, government spending, foreign exchange demand, monetary policy, imports, banking activity, and the country's relationship with international financial institutions. Therefore, anyone expecting the dinar to behave like an Asian manufacturing currency is starting from a flawed comparison. However, there is a valuable lesson here for IQD followers. Currency valuation is often about economic policy objectives rather than simply deciding that a currency should be worth more. If a central bank maintains a particular exchange rate framework, there are reasons behind that policy. Those reasons can include inflation control, financial stability, import costs, foreign exchange management, and maintaining confidence in the monetary system. A stronger currency can have advantages. It can make imported goods cheaper, reduce the local currency cost of foreign products, and potentially help consumers. But currency appreciation can also create challenges for exporters if it makes their goods less competitive internationally. A weaker currency can support export competitiveness, but it can also increase the cost of imports and potentially create inflationary pressure. This trade off is one of the most important points for viewers following Iraqi dinar developments. A currency cannot simply be declared stronger because a stronger exchange rate sounds positive. Policymakers have to consider what that exchange rate does to the entire economy. In Vietnam's case, maintaining manufacturing competitiveness can be an important consideration. In Iraq's case, the equation is different because oil revenue provides the country's primary source of foreign currency. That means the relationship between the dinar and the US dollar has enormous importance for government finances, imports, monetary stability, and the wider economy. For the Iraqi dinar, sustainable currency improvement would therefore require more than speculation about a future exchange rate announcement. Investors and observers should instead watch the fundamentals that can influence monetary policy over time. These include the stability of oil revenues, government fiscal management, inflation, foreign exchange reserves, banking sector reforms, private sector development, digital payments, international banking relationships, and efforts to bring more economic activity into the formal financial system. Another important factor is confidence. A currency works partly because people trust the institutions behind it. If households and businesses prefer to hold large amounts of cash outside the banking system, that can reduce the effectiveness of monetary policy and limit the development of a modern financial sector. Conversely, stronger banking institutions, better payment infrastructure, greater transparency, and deeper integration with international financial systems can improve confidence over time. This is where the Vietnamese comparison becomes useful again. Vietnam's manufacturing success was not created by the exchange rate alone. The country developed supply chains, infrastructure, export industries, foreign investment relationships, and industrial capacity. The exchange rate was one part of a much bigger economic strategy. Iraq faces a different challenge. The country has substantial natural resources and significant economic potential. But developing that potential beyond oil is critical for long term stability. If Iraq can expand agriculture, manufacturing, tourism, logistics, technology, construction, and private sector services, the economy could become less dependent on government oil revenues. That would potentially create a broader foundation for monetary and financial stability. For IQD followers, the short term implication is that headlines about other currencies should not automatically be interpreted as evidence of an imminent Iraqi dinar revaluation. A policy decision in Vietnam does not establish what the central bank of Iraq will do. Likewise, movements in the Vietnamese dong do not provide a reliable timetable for the Iraqi dinar. The more useful question is what is happening inside Iraq itself. In the short term, viewers should pay attention to official statements from the Central Bank of Iraq, developments in foreign exchange management, banking reforms, inflation trends, government budget policy, oil revenues, and international financial relationships. These indicators provide much more meaningful information than social media claims about specific future exchange rates. In the longer term, Iraq's currency outlook will depend heavily on whether economic reforms can translate into stronger productivity, greater financial sector participation, and a more diversified economy. If those developments occur gradually, they could create better conditions for monetary stability. But that is a process rather than a single event. There is also an important lesson about the word weak. A currency with a large numerical exchange rate against the dollar is not automatically economically weak. The number of local currency units required to purchase $1 is simply one way of expressing the exchange rate. What matters economically is purchasing power, inflation, productivity, income growth, external balances, and confidence in the currency. The Vietnamese dong is a perfect example of why viewers should be careful with simplistic comparisons. Vietnam can have a relatively low nominal exchange rate while simultaneously developing a highly competitive export economy. Likewise, Iraq can maintain a particular dinar dollar exchange rate framework while pursuing reforms intended to strengthen the financial system and economy. So, when we hear the argument that the dong could remain weak because Vietnam needs to compete with China, the reasonable interpretation is that policymakers may have incentives to avoid excessive currency appreciation if they believe it could undermine export competitiveness. But that does not mean the dong must remain weak forever. Economic conditions can change, productivity can rise, trade relationships can shift, and monetary policy can evolve. The same principle applies to the Iraqi dinar. There is no responsible basis for guaranteeing a specific future exchange rate. What we can do is monitor the economic conditions that would make any major policy change more or less plausible. For the Iraqi economy, diversification remains one of the biggest long term opportunities. A more diversified economy could generate additional sources of foreign exchange, create employment outside the public sector, strengthen domestic production, and reduce vulnerability to fluctuations in oil prices. Banking reform is equally important because a modern economy requires efficient payments, credit markets, transparent financial institutions, and stronger connections to the global financial system. Ultimately, the biggest takeaway from the Vietnam discussion is that currency policy is a tool, not a magic solution. Governments use monetary and exchange rate policies alongside fiscal policy, trade policy, industrial policy, and financial sector reforms. A currency's future cannot be separated from the economic system supporting it. For Iraqi dinar followers, that means the most valuable information is not simply a prediction about whether the dinar will rise or fall. The real story is whether Iraq is building the economic conditions that can support long term monetary stability and sustainable growth. So keep watching the official economic data, central bank communications, banking reforms, government fiscal developments, oil market conditions, and Iraq's progress toward a more diversified economy. Those are the indicators that can help us separate genuine economic developments from speculation. Thank you for watching Iraqi Dinar News. Make sure to subscribe to the channel and like the video if you want responsible, factual, and carefully analyzed updates on the Iraqi dinar, Iraq's economy, and important developments in global currencies. Remember, currency markets can be unpredictable and no specific exchange rate outcome is guaranteed. This content is provided for informational and educational purposes only and is not financial advice.